Good evening.
Good
Thanks
evening.
for
Thank you.
making an appearance.
Thank you. Always good to be here.
Away from the raking of the leaves.
The raking of the leaves.
Right.
It's constant.
Tis the
It's
season,
never
right?
ending.
Tis the season.
But it's been great. The weather's been nice, so it's been okay to be outside. That's for sure.
It's been a great fall here in the Niagara region. On today's show, we have a really great timely topic. We're filming this show in early November, and the topic is, Jason, a year to forget in the financial world, and it's been a really, really difficult period. 2022 will not go down in any record book as a year of fun in the sun, that's for sure. But we think about it right now. What's been happening this year? I call it the four pillar effect. Is we've had the stock market correct itself this year. We had a number of good years during COVID, and the market's corrected itself. We have inflation that we haven't seen in decades. We have high interest rates that have gone higher and higher and higher, and really putting a damper in people's spending and people's their budgeting, and of course the housing bubble, Jason. But just to kind of touch base on some of these core topics, and again, we talk. Our first topic here we're going to get into is the stock market correction, and you think about it right now, it's been a really challenging time. We're having meetings. Everybody in this industry is having meetings with their advisors or with their clients. Clients are coming in seeing their advisors. And if you look at it right now, it hasn't been that pretty. If you look at the NASDAQ exchange in the U.S., which is the technology exchange, it's down 33% year to date. The bellwether exchange, which is the S&P 500 in the U.S., which is the 500 biggest companies, it's down 21%. And then you've got the S&P TSX here in Canada, it's down about 8%. So nowhere in the world have we seen any of the general stock markets this year have anything but negative performance.
Right, and even some of the darlings from the 90s or from the 2000 to 2010 and all the way up to 2020, we had some of the darlings like Facebook, Amazon, Netflix, Google. They're all down. Some of them, Facebook's down 70%. Microsoft even is down 30%. These are high quality, big engine stocks that everybody thought would continue to rise, but they're getting hit just as much, if not worse, than a lot of the others.
Well, what we're seeing right now is we're seeing in our client portfolios, double-digit losses. Clients are down 8, 10, 12% across the board. But when you look at the accounts that they're managing themselves, like you said, Facebook is down 71%. Google's down 38%. Google, is a great company, right? It makes a ton of cash. Microsoft down 31%. And even in Canada right now, the banks are all down across the board. Bank of Nova Scotia, one of the worst hit this year, is down 27%. So there's almost no place to cover yourself from this reigning of stock market correction. But better days are coming, obviously, and we know that. And one of the other issues with most investors this year is the bond market, right? So the Canadian Universal Bond Index, so the general bond index is down 14%, and the corporate bond index is down 12%. So Jason, typically in the past, if stocks had went down or had fallen down a little bit, your bonds would have gotten the bump. This year, stocks are down and bonds are down. And this is the first time since the 40s that both stocks and bonds are both down double digits year to date.
Yeah, exactly. And this is where the conservative investor is really getting hurt. Normally, in a down market, we've had lots of bear markets, but usually the conservative investors will lose 0 to 5% type of thing. But this year, as you said, with bonds going down at the same rate as stocks, conservative investors are down 10 to 20% as well. So it's been a tough year for everybody.
Tough year for everyone. And like we've been saying to our clients is that the bond market is down, but the bond managers, the guys that are running all the bond portfolios, they're pretty bullish going into 23, 24, 25, that they're going to see some really significant returns in their portfolio. So our position is just stay the course, hang in. The storm's almost over. I use the analogy all the time that the investment world is like it's like a season, right? You've got winter, you've got spring, you've got summer, you've got fall. Right now it's it's the end of winter. It's been a long, cold winter.
Let's hope. Yeah.
Lots of storms, lots of snow, and finally we're seeing as I always say, the groundhog. He didn't see his shadow, so we know that spring's only going to be a few more weeks away. The only place during the last year or so that hasn't been basically affected by the market crash has been the energy market. And the energy market, obviously oil, you've got the war in Ukraine, you've got a lot of issues with Russia, the supply chain. So energy stocks have done quite well. They're up about 34%. So the reason why Canada has fared better than the U.S. year to date in the stock market is because obviously we're a commodities-based country, and a lot of our returns come from the oil patch and the energy sector and commodities. The second pillar I want to get into, Jason, is inflation, right? So we know the markets are down, but the other big kicker is inflation, right? I mean, and what happened during COVID when they just flooded the market with dollars, everybody was home, nothing to do, couldn't travel, couldn't go for dinner, restaurants were closed down, people started to shop. And they started to spend money, and they were buying things. And inventories slowly went down. Inventories weren't getting replenished. And if you look at it right now, in January, the inflation rate in Canada was 5.1%. In June, it rose to over 8%, Jason, 8.1%. It's now down to 6.9%. So it started here, it's gone up, it's gone down, it's on its way down. And we haven't seen inflation like this for decades upon decades. Back in the early 90s, inflation was around 5%. So again, today we're at almost 7%, hopefully on its way down. But back in the 90s, early 90s, it was around 5%. Back in the 80s, it was closer to 15%. Back in 1992 to 2020, we had low inflation. We got spoiled with about 30 years of really low inflation in around 2%. After COVID in 2020, inflation started to rise a little bit to 3.4%, and it's where we're at today. But we do know that the Bank of Canada's mandate is the Bank of Canada is telling us we will do whatever it takes to get inflation back under that 2% range.
Right, and most experts that we see say that it's probably the fall of 2023 is when we expect to see interest rates coming back down to the 2-3%. So. Yeah. Fingers crossed. It's an overlooked aspect of financial planning. We used to not talk about it a lot because of but now with the purchasing power diminishing, it's an important aspect of financial planning.
Well, you can see why the bank wants it around 2% because obviously you look at what's happening with strikes and different industry wants. They want higher pay raises. Obviously, they need it because cost of goods have gone up, but we don't want to see prices go up of our cars and our homes and our appliances at a 5 or 6 or 8% clip. People's incomes just don't rise that quick, so it's really important financially. The Bank of Canada keeps inflation around 2%, and again, it's our opinion, and what we've heard is probably starting by July, August, September of this year, second half of the year, you'll start to see inflation come under control. And hopefully by the end of 2023, going into next year, it's back under control. Jason, the third pillar here of some of the worries that we're trying to forget in 2022 are our interest rates right now. So we have seen interest rates. I mean, this is where it hits people in the pocketbook. It's the most painful. We've had 6 rate increases this year. The Bank of Canada has been raising interest rates and raising interest rates. They've actually raised interest rates by 3.5% over 7 months, which isn't a good thing. It's much more, easy to take when it's a slow increase. Gives us time to kind of get used to it. But when all of a sudden they increase it in dramatic increases, it's pretty challenging. Again, we were spoiled between 2010 and 2020. And most of us have, I think, a short-term memory. We think that interest rates were so low back in 2021, 2020. I can remember you could get a variable mortgage at 1.5%. People think that was the rate that was here forever, but we did get spoiled with low interest rates for about 10 years. But going back, there were some times when rates were in this range, which interest rates today are around 6%, which is the prime lending rate. Back in the early 60s, back in the mid 90s, and again we had some lower rates between 2001, 2007, and then again 2008 to 2021. So we've had some low rates, we've had some high rates, but I think it's important that interest rates at some point, the government says enough is enough. let's start to bring interest rates back into line.
Right. And who can forget the 80s when we had interest rates, well into the double digits, right?
18-20%.
Right. Some good when you're buying a GIC at 10%. It sounds great, but when you're paying 15% interest on a mortgage payment, it can hurt.
Yeah, and I think this is like a bit of a domino effect. Is what we're going to see happen here is we're going to see stocks recover first, and we're seeing stocks recover right now. We're going to see inflation get under control. That will recover next. We'll get inflation under control. Third is going to be interest rates. So once we start to get the news from the government that inflation's under control, they can then start to take their foot off the pedal, maybe bring interest rates back down 1% to 2%, which would be great. And where instead of paying, these days you buy a 5-year mortgage, it might cost you 6-7%. Yeah. It'd be nice to get it back down to where a 5-year mortgage was in the 4 to 5% range, and hopefully, if you go variable, a little bit cheaper. Yeah. The final piece of the puzzle that has to fall, which we think might not be falling for another 12 to 24 months, are home prices, right? So we think back in 2021, if you look at the average price of the Canadian home, over time it rose in a nice steady line. But back in 21, we saw this massive bubble of prices, which were just unbelievable to most home buyers. So home prices in 2021 went up to a high of about 28% over traditional, inflationary levels, and we're now seeing that pop a bit. We do know there were some reports, Jason, from the Canadian Real Estate Association, and they talked about some of the facts that Canadian home sales are down 31% over the past 12 months, and prices are down about 7% nationally.
Yeah, and as you mentioned, this is the last piece of the puzzle. Eventually, they'll start to slowly decline. We see it almost every day in our practice when people are refinancing their mortgages, and all of a sudden they've got a $400 or $500 increase in their mortgage payments. That has to dramatically affect the home pricing. So we do expect that to be the final piece, and maybe rightly so. It was 6 to 8 months ago, a year ago, you couldn't keep a house on the market for more than 48 hours, and people were just bidding like crazy, and it was out of control.
So again, just to kind of reset the stage here, is the 4 pillars that are causing a year to forget in the financial world is it's the stock market, it's the inflation market, it's the interest rate market, it's the housing market. So we know that stocks have started to rebound. It's been a pretty good quarter for investors this quarter. Hopefully it continues and we have a good end to the year. We'll have a positive quarter and get some of those losses back. We know that's starting right now. That's the first pillar to fall down, the first shoe to drop, as they say. The second shoe to drop would be inflation. Hopefully by the middle to the end of next year, we'll see inflation back under control. That's step 2. That helps all investors. Step 3 is going to be interest rates, which will follow that up. And hopefully in 2023, late 23, maybe 2024, we'll see interest rates come back down again. And then finally, by end of 24, beginning of 25, we'll see the real estate market hopefully hit its point where it's going to slowly recover. So lots to think about, lots to worry about. But again, stay the course. Don't panic. Don't make a bad decision. Talk to your advisor. Make sure you get some good insight. And hopefully people, Jason, kind of can get through this year and we can look back on this in 2 or 3 years. And
good riddance to 2022.
Yeah, exactly. Yeah. For those out there, again, feel free to catch us on YouTube. We have our YouTube station, It's Your Wealth, the podcast. We're also on Apple iTunes, and we're also on Spotify.